Hello, and welcome to our fifth annual Global Private Equity Report, in which Morrison Foerster's Global Private Equity team reviews the key trends from 2024 and presents the outlook for 2025. I'm Marcia Ellis, Global Co-Chair of Morrison Foerster's PE practice.
I'm Patrick Heward, also Global Co-Chair of our Private Equity practice.
As 2024 closed, we found that many of our predictions for last year's global PE market came true, including
the Federal Reserve's interest rate cuts have spurred increased deal activity in the US, UK, EU, and Japan. While the US economy remains resilient, global M&A activity continues to face challenges.
Middle and lower middle market deals dominated M&A activity in 2024, particularly in the TMT, industrials, and healthcare sectors. Notably, there was also an increase in high-end deals exceeding US dollars 500 million.
Competition from non-bank lenders grew, driving a trend toward diverse capital structure. This flexibility allowed sponsors to stay agile and innovative in their deal making.
Private equity firms demonstrated strong interest in tech M&A, with total transaction value for the first 3 quarters of 2024 rising by 39% compared to the same period in 2023.
Despite ongoing antitrust headwinds in the United States, 2024 saw a rise in healthcare M&A activity, particularly in the healthcare services, biopharma, and medtech subsectors.
China-focused PE sponsors increasingly turned to investors from the Middle East and Singapore for fundraising and explored alternative exit channels. Meanwhile, PE firms reduced their China exposure, adopting a China Plus One strategy to diversify investments.
The PE-backed take-private trend continued in 2024, with notable momentum in Japan. These deals remained popular due to attractive valuations, rising compliance and corporate governance costs of staying public, and the significant dry powder available to PE firms.
The very loud anti-ESG backlash, in fact, had very little impact. PE firms remain committed to sustainability, integrating it as a core consideration in their investing and hiring decisions.
Now let's take a look at what we can expect in 2025.
With anticipated interest rate cuts and companies seeking growth opportunities, deal flow is expected to be stronger in the coming months, particularly in the US and Europe, compared to the last 18 months.
Potential pro-tariff policies could dampen cross-border activity and reshape the M&A landscape. However, tariff avoidance strategies may drive increased M&A deals in countries less affected by new tariffs.
While the U.S. anticipates a more lenient regulatory environment, increased regulatory scrutiny over M&A activities will persist in other regions across the globe, potentially creating significant barriers to cross-border deal-making.
A more tax-friendly administration in the United States is expected to drive deal activity, boosting deal volume for both bank and private credit lenders. Lenders are eager to deploy accumulated dry powder, especially as quality assets become available in the market.
Tech deals are set to increase, driven by AI as a key factor. According to our 2024 M&A Tech Survey, 47% of respondents identified AI and machine learning as the greatest opportunity at present.
PE activity in life sciences and healthcare is expected to gain further momentum, with capital available to fuel innovation, convergence, and consolidation in the industry.
While US and UK-backed PE firms are expected to reduce their exposure to China, Asia-headquartered China-focused PE firms view the current economic environment as a strong buying opportunity. In addition, Middle East-based sovereign wealth funds are likely to increase their investments in China.
The trend of private equity-backed take-privates is expected to continue globally, with a significant rise in UK-listed companies delisting from the London Stock Exchange in favor of PE ownership, often aiming for a relisting in the United States.
PE firms are expected to pursue take-privates of Tokyo-listed companies and China-headquartered US-listed companies.
ESG will remain in a tug-of-war, with the EU's sustainability directives and reporting standards pushing it forward, while the new US administration moves towards a less ESG-friendly environment.
Apart from the global trends we just covered, the report also includes our predictions for the US, Latin America, UK, Europe, China, Southeast Asia, Japan, and India. We also discussed some of the most relevant themes in the PE industry today, including AI, life sciences, food and ag, ESG, data centers, finance, and special situations.
Thank you very much to all our global team members who contributed to this report.